Hello. Welcome to our next IND AS, that is your IND AS 19. IND AS 19 is a very important IND AS that is about employee benefits. So I have broken this entire chapter, entire IND AS into four parts, and this will be very easy for you. So the first part is your short-term employee benefits. So short-term employee benefits are those benefits other than termination benefits which are expected to be settled in 12 months from the end of reporting period. So that means basically your definition of current assets. Anything which is expected to be settled. So this is going to be settled within 12 months from the end of the reporting period. So say for example your wages, salaries, any paid annual leaves, your sick leaves, any profit sharing and bonuses. All of this comes under your short-term employee benefits. Now there are two types of paid balances. One is your accumulating paid balances, and second is your non-accumulating paid balances. So when we say accumulating paid balances, this means say for example you have 10 leaves every year, and if this year you utilize only 7 leaves, so the 3 leaves that you did not utilize, these will be carried forward in the next year, and instead of 10 leaves, you will have 13 leaves in that year. That means of carry forward. So you will recognize liability only for vesting. So there is two types. It will either vest or it will not vest. So if the employees are entitled to cash payment for unutilized leaves, say for example, an employee can encash his leaves. In such a case, it will be called vesting. So you will recognize liability only if you will have to pay the employee for the leave that he has not taken. If it is non-vesting, that means employees are not entitled to cash payment for unutilized leave. So if I do not have to pay any cash to the employee, whether it is carrying forward or not, if I do not have to pay cash, I do not recognize the liability. As simple as that. So we will recognize liability only and only. We will recognize liability only and only if it is vesting carry forwarded leaves. Next is your non-accumulating paid balances. That means if you do not take any leave, they lapse. If I have given you, if I have allowed you 10 leaves and you do not take 10 leaves in this year, next year this will not be carry forwarded. So you do not recognize any liability because I don't have to pay only. Then why do I recognize a liability? So absences that do not carry forward and will lapse after the current period. Employees are not entitled to cash payment for unutilized leave. So these are not allowed to be carry forwarded and they will lapse. And employees are not entitled to cash payments for the unutilized leave, not entitled to any cash payments. Next that we did is the profit sharing and bonus plan. So profit sharing and bonus plan, you will recognize a liability. You will recognize a liability only and only if the entity has a present legal or constructive obligation to make such payment. If it has a present legal or constructive obligation to make such a payment as a result of past event, and reliable estimate of obligation can be made. So there are two things. You will recognize liability only if there are two things. First is there is an obligation to make payment, and second is a reliable estimate can be made for how much payment has to be made. So this was your first part of the chapter out of the four parts. Okay, I hope it is easy so far. Next comes your post-employee benefits. Post-employee benefits, now this is a little complicated, but I have tried to make it as easy as possible. So these are employee benefits other than termination and short-term benefits. Employee benefits other than termination. Termination is the benefit that you pay once the employee is leaving or you are removing. It is payable after, of course, it says post-employment, so it is payable after the completion of employment. So say for example, your pension, your any lump sum payments, post-employment life insurance, post-employment medical, or all of this comes under your post-employment benefits. Then there are two types of risk that you should be aware of. First is your actuarial risk and second is your investment risk. So actuarial risk is the risk that the benefit will be more or less than expected. So what happens is we have to analyze as to how much benefit will we have to pay after employment. So this calculation is done by an actuary. And actuary makes an estimate that sir you will have to make so and so amount of payment after employment. This is to the entity. Now it is very much possible that say for example an actuary estimated that sir you will have to pay 100 rupees but our actual payment comes to 120 rupees. So now this 20 rupees that is extra is an actual risk, that is risk of calculation of wrong amount. And second is your investment risk. That is risk that the investment amount would not be sufficient to pay liability. So you also invest something. You invest some X amount which grows by some percentage each year. That is your growth. So based on that you make a investment. So if this amount you feel it will not be sufficient, that means it will be less than the liability required to pay. This is your investment risk. Okay. So basically if we were to see, actual risk is the planning risk and investment risk is the return risk. Next is your defined contribution plan. So there are two types of plans where whenever an entity has these plans for its employees. So there are basically two types of benefits. Either the entity says ki I will define how much I will contribute to the plan. So entity says every month I will transfer 10% of your salary. I have defined how much I will contribute. Say I will contribute 10% of salary. So entity's obligation is limited to the amount it agrees to contribute to the fund. I have promised I am contributing 10%. That is my only liability. So actuarial risk and the investment risk fall on the employee and not on the entity, because I have done my part. I have paid 10%. Now if this grows, if this does not grow, if this is the wrong amount, I don't care. All of this actuarial risk and investment risk is employee's risk, not my risk. So what will be the journal entry? Expense account debit to cash or liability. That means if you unpaid, so it will be a liability. So expense account debit to cash, because of course your cash is going out when you pay. So not required to discount cash flow if obligation is within 12 months. Of course, if it is within 12 months, what will you find the present value? Next is your defined benefit plan. Defined benefit plan is which is complicated for the entity, because what does the entity say? Ki, boss, when you retire, if you are an employee, when you retire after 60 years of age, I will make sure that I will give you say rupees 60 lakhs. So now I am defining what benefit I will be giving to the employee. I have not said that I will only be contributing this much. I'll have to contribute whatever amount, but I will give you 60 lakhs at the end. This is your defined benefit plan. So in this case, the entity's obligation is to provide agreed benefit. In this case, the agreed benefit is 60 lakhs to current and former employees. Actuarial risk and investment risk fall on entity and not on the employee. Over here, it is the risk of the entity, because say for example, the entity made some calculation and they say ki if I contribute 5 lakh every year for the next 10 years, I will get 60 lakhs. That is 50 lakhs of my capital, and this 50 lakhs will appreciate to 60 lakhs based on the return. Assume that I put 5 lakh every year, but this became only 57 lakhs. So the balance 3 lakh also I'll have to put additionally, because I have promised the employee that I will pay you 60 lakhs. So therefore this risk falls on the entity. Now before we get more into depth, there are certain definitions that you should be knowing. So I put all of the definitions here. We will go through them one by one. First is your current service cost. Current service cost is increase in present value of DBO. DBO stands for your defined benefit obligation. So increase in present value of DBO. This is basically nothing in real life. In actual terms, it is just the expense contribution of the current year. That means how much of the expense, how much have I accrued this year, that will be your current service cost. Therefore, it is called current service cost because current is of current year. Service cost is service that the employee has provided. So what is the cost for the current year? Okay. Next is your defined benefit obligation. Defined benefit obligation is the present value. Remember, it is the present value of expected future payments required to settle the obligation. So in that case, what did we do? We had to give 5 lakhs every year for 10 years. So that in the end, we get 60 lakhs, right? So if we want to find out what is the defined benefit obligation, we will calculate the present value of 5 years for 10 years each. So 5 years first you will discount to 1 year, then next 5 years you will discount to 2 years. ऐसे करके you will do for all 10 years and you will calculate what is the present value. That is the amount of your defined benefit obligations. Okay. Next is your interest cost. That is increase in value of DBO because passage of time. Because DBO we have recognized at present value. After every year, you will have to add back the interest amount from what you have put it at present value. So this is your interest cost. Increase in value of DBO because of passage of time. Next is your actuarial gain or loss on DBO, that is your defined benefit obligation. Remember defined benefit obligations. So changes in present value of DBO due to actuarial assumption change. That means the actuary had made some assumption which he is now changing. So it is possible that we will have to contribute less because of the updated assumption. In such a case, we will have a gain. And if we have to contribute more because of these changes in assumption, it will be a actuarial loss on DBO. Next is your past service cost. Now try to understand if you done current service cost, then past service cost will be changes in present value of DBO for employees service in prior period, whatever service we have received in prior period, resulting from amendment. Say for example, your gratuity has reduced from 1% to 5%. So earlier it was 5%, but now it is 1%. So of course your defined benefit obligations will change. So any change in present value due to any prior period resulting from the amendment. Next is your plan assets. Now plan assets is basically your investment pool where every year we are putting that 5 lakh amount, that is your plan assets. That is assets created to fund the DBO, that is assets created to fund the defined benefit obligations. It can only be used to settle the DBO and it will be measured at fair value. So every year we were putting 5 lakh. So that is basically an asset that we are creating to pay off the 60 lakh of defined benefit obligation. Next is your expected return on PA. Expected return in our case was what? 10 lakhs. Because we were putting 5 lakh each year, 5 lakh each year, 5 lakh each year, we were accumulating a pool of 50 lakhs. How much do we have to pay? We have to pay 60 lakhs. So therefore, we are expecting a return of 10 lakhs on this. So therefore, rate of expected return is same as the discounting rate used to find the present value of the DBO. Next is your actuarial gain or loss on planned assets. So it is the actual return on planned assets minus expected return. So the actuary also calculates that what will be your expected return on this planned asset that you have created. So if there is any difference between the actual return that I have received and the return that was calculated by the actuary, in such a case, this is called actuarial gain or loss on PA, and this will be transferred to your OCI. Remember, this will be transferred to OCI. Next is curtailment. So curtailment is when number of employees covered under the plan is reduced. Say for example, earlier 100 employees were covered. So I calculated if was for 100 employees, I'll have to pay so much amount at present value. But now what has happened, instead of 100 employees, there are now only, say for example, 40 employees. So I will have to reduce my obligation for the 60 employees. So in such a case, curtailment happens. What is settlement? Settlement is when the entity settles defined benefit plan before the due date. Say, for example, my due date was 10 years later. But if I settle it before 10 years, so in such a case, a settlement happens when the defined benefit plan is settled before. Next is the net defined benefit liability or asset. Net defined benefit liability or asset, that is net of plan assets. Net of plan asset, that is your value of the assets that you will be using to pay off the obligation. So that is the net of plan assets and present value of DBO to present in balance sheet subject to asset ceiling. So basically net, basically you can put this as formula, that is plan assets minus present value of DBO. This is basically your formula. To present in balance sheet subject to asset ceiling. That means if your plan assets, say for example, your plan assets is of 100 and your present value of defined benefit obligation comes to only 70, but an asset ceiling has been specified of say rupees 17. So in such a case, this 30 rupees difference, because you have assets more than your liability, 70 is basically a liability, so you have 30 rupees extra. So out of this 30 rupees extra, 17 out of this 30 rupees extra, this 17 will be shown as a net defined benefit asset, but the rest 13 cannot be showed because the asset ceiling, that is, they set the ceiling at 17, so you can only show 17. The 13 cannot be showed as an asset. Okay. Now next is your net interest, that is interest expense. That is unwinding of discount on DBO. So DBO, the 5 lakh, 5 lakh, 5 lakh, we have discounted it to today's value. So whatever discount we will unwind every year minus your interest income, that is expected return on plan assets. So say for example your plan assets have been invested at 7%. So you will each year you will earn 7% on that. This is that income. Next is your asset ceiling that we studied. That is the maximum amount that is available in the form of refunds from the plan. Basically, an entity can only maximum take some certain amount. The balance figure will be shown in OCI. So 17 lakh was the asset ceiling. Next is the remeasurement gain or loss. So any actual gain or loss on DBO, any actual gain or loss on planned asset, and any changes due to asset ceiling, all of this will be shown under remeasurement gain or loss. So I hope the definitions are clear and we'll move forward. Okay. So this is where the chapter gets over. This is the entire chapter of the second page, and we'll get done. So steps for obligation computation, that is if you want to calculate what will be your present value of defined benefit obligation. So first is calculate the total benefits to be paid in the end. So say for example, I have to pay rupees 500 after 5 years. But so my liability is of rupees 500 after 5 years. So what do? I will calculate the cost of each year, that is total benefit divided by number of years. So that means basically my cost of each year comes to rupees 100 rupees per year. Find the current service cost. Now to find current service cost, you have to calculate 100 rupees at present value, because you have to do 100 rupees every year. So 100 divided by 1.1. So assume that the rate is 10% by what we are discounting. So therefore 100 divided by 1.1 raised to the power 4, because year 1 we are putting at the end of year 1. We are putting the amount at the end of year 1. So it will be it will remain invested for how many years? It will remain invested for 1 year, 2 years, 3 years, and it will remain invested for 4 years. So therefore 100 rupees we will be discounting by 4 years. Year 2's contribution we will be discounting by 3 years. Year 3 contribution we will be discounting by 2 years, and so on. So basically your opening balance of DBO at year 1 will be 0, because there is no opening balance. There will be no interest. Then there will be current service cost, that is your step 3. So in year 1 it will be 100 divided by 1.1 raised to the power 4. This will be then your closing balance will be opening balance plus your interest plus your current service cost. Now this amount will be your closing balance, and this amount will be opening balance of year 2. And again same entry, and this will keep on passing till year 5. Next is your present value of defined benefits obligation, that is your PVDBO. So your opening balance, you will have some opening balance. You will add interest on opening balance. Interest on opening balance will be added. Then you will add your current service cost, that is your cost of current year. You will increase any past service cost, if there is any increase in past service cost, that will be added. If there is any decrease in past service cost, that will be subtracted. If any benefits have been paid out of the plan, of course you will have to subtract that. Any liability reduced due to curtailment, that means the number of employees covered have been reduced, so that will be good for us, therefore it will be subtracted. Then any actual gain will be subtracted, and actual loss will be added, and this will be your closing balance. So now say why gain will be subtracted, because this is basically this is nothing but a liability. So your liability will increase when you are having a loss. Therefore, on having a loss, this amount is being added. On having a gain, this amount has been subtracted. Next is your plan assets. Plan assets, of course, is a asset by nature. Okay, you will have your opening balance. Then whatever contribution you make to your assets in this year, that will be added. If you withdraw anything to pay benefit, that means over here benefits paid, and over here withdrawal to pay benefit, this is the same amount. So this will be subtracted. any payment due to curtailment. So this curtailment is here also, curtailment is here also. And plan assets, you will also get some return on it. So your actual return, whatever actual return you are getting, that will be added, and you will get your closing balance. So usually what happens, you also get the closing balance. So this actual return you can use as a balancing figure. That means you will realize as to what is your actual figure, actual return, how much have you earned. Therefore, I have circled it for balancing figure. So your what is your expected return? Expected return is opening your opening balance into the rate that your fund has earned. That will be your expected return. And expected, whatever is expected minus your actual return becomes your change in return. Okay. Now coming to your last part, that is your P&L. That is what all items will hit P&L. So any current service cost will of course impact P&L. Any increase in past service cost will also impact P&L. Any gain on curtailment, if you gained on curtailments, of course P&L say it will be subtracted, because basically we are, when we say P&L over here, we are doing cost expense. So therefore any gain will be subtracted. Any loss on settlement will be added. Interest on PVDBO will also be added because it is a liability. Interest on planned assets, because you are getting this planned assets. So basically all incomes we are subtracting and all expenses we are adding over here. So interest on P as an income, therefore we are subtracting, and you get your total expense. And last part is your OCI. What items come under OCI is any actuarial gains or loss on DBO, any actuarial gains or loss on planned assets, and any loss due to asset ceiling. All these three will go to OCI. And we've finished with the major part of the chapter. Coming to the last part, that is your special plans. There are some multi-employer plans. So what happens in this case? Say for example, I have my company, you have your company, and another third person has their company. So what do we do? Instead of me managing my own fund, you managing your own fund, that third person managing their own fund for their own employees, what do we do? I think, come, let's make a team. Let's all of us collaborate. Let's all of us put money together so that we settle liabilities of all employees together. So in such a case, it is a pool assets contributed by various entities. So these are non-group entities. That means it is not holding subsidiary. We are separate entities, and we plan ki let's make a pool together. Next is your group plans, that is shares risk between entities under common control. This is your parent subsidiary. Say for example, I have a parent and we make our own plan. So this is your group plan. Next is your state plans, that is established by a legislation or operated by national local body. So when the state or when the government makes such a fund, it is called your state plans. And last is your insured benefits, that is obtains insurance from insurance company towards retirement benefit plan by paying insurance premium. So what happens, if I have promised the employee, boss, I have to pay you 50 lakhs at the end of 5 years. So instead of me managing my own assets, me managing my own investment, my planned assets, what do? I pay some premium to the insurance company. See, boss, I have paid you this amount. Now, whenever the employee has to be repaid, why you look at this? I will only pay you the premium amount. You pay the employee whenever you have to settle it. Okay. Next is your other long-term employee benefits. So employee benefits which are expected to be settled after 12 months from end of the reporting period. So say for example, your sabbatical leave, when you take a longer leave, any long-term disability benefits, any deferred remuneration, profit sharing and bonuses when it is for more than 12 months. Accounting will be the same as the defined benefit plan, except remeasurement gain or loss will be recognized in P&L and not in OCI. So till now we were measuring all revaluation, all remeasurement gains in OCI, but in this case we will be measuring them in P&L. Okay, and over here DCP and DBP is basically defined contribution plan and defined benefit plan. Over here, your DCP and DBP is defined contribution plan and defined benefit plan. Whether it is possible or not is what I have mentioned. Last part of the chapter, fourth part, is your termination benefits. So result of termination of employee by entity. So that is only when the entity is terminating the employment. The benefits are not conditional on future service being provided. Termination benefits do not include employee benefits resulting from termination of employment at request of employee. without an entity's offer or as a result of mandatory retirement requirements. Read the statement again. Termination benefits do not include employee benefits resulting from termination of employment at request of employee. If the employee has requested termination, then it is not covered under fourth part, or as a result of mandatory retirement requirements. Discounting is to be done if the termination benefits are expected to be settled after 12 months from the end of the reporting period. Of course, only then we will be discounting. Recognize liability and expense for termination benefits at earlier of following date. So that is basically, when do we have to recognize? When an entity can no longer withdraw the offer, or when the entity recognizes cost for a restructuring which is within the scope of IND AS 37. So whenever you recognize cost for restructuring, or when the entity can no longer withdraw the offer, whichever is earlier. And with this, we are done with this IND AS, and I will see you in the next one.